It started. Less than 2 hours ago, the United States and Israel launched joint military strikes on Iran. Massive explosions have been confirmed in Tehran, the Iranian capital. President Trump posted a video on Truth Social confirming that the U.S. military has begun major combat operations in Iran. Israeli Prime Minister Netanyahu announced this will last as long as needed. Iran has launched retaliatory missiles toward Israel. Sirens are sounding across Israel and U.S. military bases in Qatar, Bahrain, and Abu Dhabi. Gold is trading above $5,000. Silver broke $91 earlier today and is holding gains. Oil is above $70. And everything we have been tracking for the last 2 weeks, the Iran timeline, the delivery pressure at COMEX, the Shanghai premium validation, all of it is converging right now in real time. Let me show you what this means for your gold and silver positions, why this is not the time to panic, and why I believe the next 60 to 90 days will prove that physical precious metals are the single best insurance policy you could have bought. Start with what actually happened because the details matter. According to multiple verified sources, including the Associated Press, CNN, Washington Post, and Al Jazeera, the first strike hit near the offices of Supreme Leader Ayatollah Ali Khamenei in downtown Tehran. It is not clear if Khamenei was present. He has not been seen publicly in recent days, and Reuters reports he has been transferred to a secure location. Additional strikes hit cities across Iran, including Isfahan, Qom, Karaj, Kermanshah, and the western Ilam province. Trump's video statement confirmed this is major combat operations, not a limited strike. Quote, "Our objective is to defend the American people by eliminating imminent threats from the Iranian regime." Netanyahu's statement was equally clear about duration. This will last as long as needed. He described it as a joint action with the United States to remove the existential threat posed by the terrorist regime in Iran. Israeli Defense Minister Israel Katz said the goal is to remove threats without elaborating further, but a person briefed on the operation told NPR it was expected to last a few days, with Israel's military focusing on targeting Iran's missile program. A 48-hour state of emergency has been declared nationwide in Israel. That 48-hour window suggests this is the opening phase of a multi-day or potentially multi-week campaign, not a surgical one-day operation. Iran's response began almost immediately. The Israeli military confirmed it identified missiles launched from Iran toward Israel. Air raid sirens sounded across Israel at approximately 8:15 a.m. local time. Defensive systems are operating to intercept the threat. There have been reports of explosions in Bahrain, Abu Dhabi, and Qatar, all of which host U.S. military bases. Bahrain's Interior Ministry urged citizens to move to the nearest safe location immediately. An Iranian official told Reuters that Tehran is preparing for retaliation that will be crushing. Iranian state TV reported Iran is preparing to take revenge on Israel and deliver a strong response. A senior Iranian official told Al Jazeera that all American and Israeli assets and interests in the Middle East have become a legitimate target and that there are no red lines after this aggression. That language, no red lines and all assets are legitimate targets, is as serious as it gets. It means Iran is signaling that U.S. military bases, oil infrastructure, shipping lanes, and potentially civilian targets in allied nations are all within scope for retaliation. This is not containable to a bilateral Israel-Iran exchange. This is regional escalation with global implications. Now let me show you what markets did the moment this news broke. Gold, which had been trading around $5,100 earlier this week, is holding above $5,000. Silver broke $91 earlier today, up more than 6% in a single session before pulling back slightly. Oil surged above $70 on WTI and $75 on Brent. The Strait of Hormuz, through which 20% of global oil supply passes, is now at the center of the risk calculus. If Iran attempts to close or disrupt traffic through Hormuz, oil could spike to $80, $90, or $100. And at $100 oil, the economics of silver mining change dramatically. Energy is the largest variable cost in extraction and refining. When oil doubles from 50 to 100, marginal silver mines that were profitable at current prices become uneconomic unless silver prices rise proportionally to cover the cost increase. Bitcoin, which has been promoted as digital gold and a safe haven, fell below the critical support of 67,000 and was trading at 66,384 at last check. That divergence, where Bitcoin slumps while gold, silver, and oil advance, reflects what Ole Hansen at Saxo Bank called a broader risk-off shift. Real assets, physical commodities that have intrinsic value and cannot be hacked or confiscated digitally, are rising. Digital assets that depend on electricity, internet connectivity, and faith in technology are falling. That is the clearest real-time validation of the precious metals thesis you will ever see. When actual war starts, people buy gold and silver. They do not buy Bitcoin. Let me address what this means for the delivery pressure at COMEX, because that story has not disappeared. It has intensified. Yesterday was First Notice Day. March contracts representing 429 million ounces in paper claims faced 98 million ounces of registered physical. Early delivery notices suggest elevated demand, continuing the pattern from January and February. Now layer war risk on top of that existing stress. Industrial users of silver who were already hedging procurement through COMEX futures are now facing a scenario where Middle East conflict threatens supply chains, shipping insurance costs spike, and transit times extend. Their response will be to accelerate hedging, increase delivery demand, and secure physical stockpiles earlier than originally planned. That behavior compounds the existing delivery stress. Samsung already went direct to mines with a $7 million facility to secure exclusive rights to La Paria output for 2 years. Tesla reportedly has similar deals. These companies made those decisions before war started. Now that war is active, every major industrial user who has not yet secured direct supply is going to be calling mining companies this week, trying to replicate Samsung's strategy. Every ounce that gets locked into direct offtake agreements is one less ounce available to satisfy COMEX delivery or to supply spot markets. The vertical integration trend that was already happening accelerates dramatically when supply chain risk moves from theoretical to actual. China's export licensing system, which restricts overseas silver sales to large state-certified producers, also becomes more significant. China controls 60 to 70% of global refined silver. If U.S.-China tensions escalate because of the Iran proxy dimension, where China has been providing satellite intelligence and Beidou navigation support to Iran, according to defense reports from earlier this month, those export restrictions could tighten. China has used rare earth export controls as a strategic tool during trade disputes. Silver is increasingly viewed as strategic for solar, EVs, military applications, and semiconductor manufacturing. Using export controls as leverage is not speculative. It is documented policy that can be adjusted quickly in response to geopolitical developments. Shanghai premium at $9.38, which we confirmed when Shanghai reopened on February 24th, is now operating in a war environment. Eastern physical buyers were already paying nearly 11% above COMEX prices before war started. If war disrupts shipping, extends delivery times, or raises insurance costs for transporting silver from west to east, that premium widens. Chinese industrial users who need silver for solar panel factories are not going to stop buying because war started. They are going to bid more aggressively to ensure supply. That wider premium creates arbitrage opportunities that drive more COMEX delivery demand as entities stand for delivery at COMEX specifically to capture the Shanghai premium. Here is my optimistic take on what happens next. Yes, war is terrible. Yes, there will be casualties. Yes, markets will be volatile. But for anyone holding physical gold and silver, this is exactly the scenario those metals were purchased to hedge against. Gold and silver are insurance. You do not buy fire insurance hoping your house burns down. You buy it so that if your house does burn down, you are not financially destroyed. War risk, currency debasement, supply chain disruption, energy price spikes, all of these are the fires that gold and silver protect against, and right now all of them are happening simultaneously. Gold at $5,000 is not overpriced in a war environment. JP Morgan's 5,400 target, Wells Fargo's 6,300 target, and individual analyst targets as high as 6,800 or even higher start looking conservative when you factor in sustained war premium. Central banks will not stop buying gold because of this war. They will accelerate. China, Russia, India, Turkey, Poland, every central bank that has been accumulating for 15 consecutive months will look at this war and conclude that dollar reserves are more weaponizable than they thought, and that gold reserves are safer than they assumed, that buying does not stop, it intensifies. Silver at $91 with a structural supply deficit, inelastic industrial demand, and war-driven supply chain risk is not expensive. Trading Keys analysis projecting price bands of 100 to 120, 120 to 150, and 150 to 180 becomes more credible, not less, when war removes supply from the market through higher mining costs, extended shipping times, or tighter export controls. David Hunter's $180 target by Q2 sounded aggressive 2 weeks ago. Today, it sounds plausible. Rashad Hajiev's $250 target, if the gold-silver ratio compresses to 30, sounds less like speculation and more like mathematical extrapolation of current trends. Let me give you the timeline I am watching. Over the next 48 hours, watch Iranian retaliation. Iran has promised crushing response. If that response hits U.S. bases, causes casualties, or disrupts oil infrastructure, the escalation intensifies and war premium in gold and silver expands. If the response is contained and damage is minimal, markets might consolidate briefly before the next phase. Over the next week, watch oil prices. If oil sustains above 75 and moves toward 80 or 90, mining costs increase and marginal silver supply comes offline. That tightens physical markets further and supports higher prices structurally, not just from war premium. Over the next 2 weeks, Watch COMEX March delivery. If notices exceed 100 million ounces and the exchange is forced to raid SLV or deploy cash settlement, confidence in paper silver collapses and physical premiums widen. Over the next 30 days, watch whether direct mining deals accelerate. If multiple companies announce Samsung-style offtake agreements, it confirms that industrial users view exchanges as unreliable and are securing supply through vertical integration. That removes supply from markets permanently and creates structural upward pressure on prices. Here is my final optimistic message. We have been building toward this moment for 2 weeks. We called the Shanghai premium. It came true. We called first notice day stress. It is happening. We called war risk repricing precious metals. It is happening right now. Every prediction based on structural supply-demand fundamentals and geopolitical analysis has been validated by events. The falling knife narratives are gone. The speculative blow-off claims are discredited. What is left is the structural case playing out exactly as the fundamentals predicted. I am holding physical gold and silver. I held through the correction. I held through the Shanghai closure. I held through first notice day. And I am holding through war because this is exactly why I own these metals. Not to speculate on price, to protect against the scenario where everything that can go wrong does go wrong simultaneously. Currency loses value. Supply chains break. Energy spikes. Wars start. When all of that happens at once, gold and silver do not just hold value. They gain value because they are the assets people run to when everything else feels unsafe. Stay calm. Stay positioned. Trust that physical metals in your possession are the safest assets you can own when the world is on fire. The next 60 to 90 days will prove that thesis beyond any doubt.